Quick note before we dive in, what you're about to hear is a fictional dramatization created for infotainment purposes. Any resemblance to real people, companies, or events is purely coincidental. Our goal is to explore the strategic decisions that shape deals, not to disclose or reference any real transaction. Now let's get into today's case.
Today, we're stepping into the boardroom and the battleground of Midwest Secure Plans, a steady but aging 401k administrator based in Ohio. The founder, Art Schumacher, built it with grit and loyalty. But now, AI, outsourcing, and platform strategies are rewriting the playbook. And Art's legacy may hinge on one offer from an unfunded sponsor with a bold vision. Today's case, the transformation premium. Is it foresight or fantasy?
15 million? 15 for a business with 600,000 in EBITDA last year? Bill, with all due respect, is this Diaz kid living in fantasy land?
This is based on a multiple of what? 25? It's not even a multiple of our numbers. It's a multiple of some future version of us that doesn't exist yet. What's he even basing this on?
Future state EBITDA under a transformation plan. He's assuming that if you implement his AI stack, offload planned compliance ops to the Philippines, and consolidate 3 smaller 401k players under one banner, you're looking at 3x scale and a 45% gross margin within 24 months.
So he thinks we'll become the Amazon of 401k plan servicing in 2 years.
More like the Tesla with outsourced battery factories. I read the LOI. He's modeling margin expansion on systems we don't have, teams we haven't hired, and acquisitions we haven't made.
Exactly. I've built this company one handshake at a time. What he's offering isn't based on what this company is. It's based on what he thinks he can turn it into. That's not valuation, that's alchemy.
I hear you, Art, but this is a type of deal we're seeing more of. Sponsors betting on operational uplift and buying into execution upside. It's high conviction, high risk, but the starting price, 15 million base with up to 5 million in earnout, it's a strong anchor. It's just contingent.
Contingent? On him turning my Ford into a Falcon 9? No offense, Bill, but this offer feels more like a pitch deck than a deal.
And what about the people? He's got a line here. Optimize workforce deployment through role clarity and tech augmentation. Sounds like he's going to gut our staff and bring in bots.
He says otherwise. Wants to retrain, upskill, and reinvest savings into growth. But look, this is why we have diligence. If you're not sold, we hold the line. But the upside story is real. The question is, are you willing to price in possibility or only history?
History got us this far. Let's see if his math checks out before we let him rewrite it.
Thanks for hopping on. First off, I want to make it clear that our interest is serious. We see MSP as a strong foundation in a space with lots of fragmentation. That's attractive to us.
We appreciate that, Alex, but we're still unclear on the basis for your valuation. It's considerably above where similar firms are trading.
Right. From our perspective, we're not simply acquiring MSP's historical cash flows. We're looking at what the company can be with some thoughtful changes. Improved tech stack, better workflow tools, and growth through tuck-in acquisitions.
But you pricing us like that change already happened. If all those improvements are still ahead, shouldn't that upside belong to whoever puts in the work to make it happen?
Fair point, and we're not ignoring that. We've structured the offer with a strong base, and we're reserving the upside potential for performance-based milestones. What we're saying is, we see the platform here. If it's the right fit, we're ready to invest behind that vision.
What we don't want is to sign on for something that feels like we're subsidizing a future we don't control. There's concern here about execution risk. What happens if the vision doesn't play out the way you think?
That's on us. We'll assume that execution risk. That's why the earnout is there, to tie future payment to actual results. What we're trying to avoid is overpaying up front for work that hasn't been done yet. The value should follow performance.
That's more realistic. Just don't try to sell us a spaceship if you're buying a pickup truck. We know what this business is today.
And that's exactly what we're buying. What it is, plus what it can become, on our dime.
Alex, I've been digging through their back office operations, and it's worse than we thought.
Worse? How?
Transaction processing is almost entirely manual. Excel files sent back and forth by email, approval chains in Outlook, no automation, no integration. They're wasting hours on what could be done in seconds. It's a miracle they haven't had a regulatory slip. I projected 20% efficiency gains in our model. Realistically, if we implement full stack, CRM integration, AI routing, OCR tools, we could be looking at 40% within the first year.
Worse is better.
Excuse me?
This validates everything. Their tech debt is our upside. The more broken the ops, the more value we can unlock. We just found the lever to justify our entire model.
So we're not lowering the offer?
No, quite the opposite. This isn't a flaw, it's confirmation. The lift is heavier, sure, but the delta is wider. We show them how we bring order to this chaos, they'll see the value.
Okay, we'll need airtight diligence. If we're going to sell this vision, we better be ready to defend every line of it.
Start drafting the operational transformation memo. Full architecture. Use this as the hook. MSP is running on wires and duct tape. We're here to install steel beams.
We reviewed your memo, Alex, and yes, there's clearly room for improvement in our operations, but the delta between your valuation and what our current EBITDA supports, it's considerable.
You're asking us to accept a future that doesn't exist yet. If your AI tools, your outsourcing plan, your buy and build strategy, all of it doesn't work the way you expect, who carries that downside?
That's a fair concern, which is why we're structuring this with a 20% earnout tied to actual performance. We hit our milestones, margin expansion, automation deployment, improve retention, you get the full value. If we miss, we both feel it.
This is standard in deals where forward-looking value plays a big role. It keeps everyone aligned. No one's asking for blind faith.
And what are those milestones exactly?
Year 1 EBITDA uplift by 30%, net margin improvement of at least 12 points, and integration of at least one bolt-on acquisition. We've modeled it tightly.
So if your spaceship takes off, we all get a ride. If it sputters, we're stuck on the launch pad.
Exactly. My team and I aren't just buying this business, we're betting on it, and we're backing that bet with structure.
It's a cleaner alignment than most, but it's still a gamble.
All deals are. This one just happens to have a little more altitude.
35 years, Sarah. I started this from my basement. We used to fax client statements one page at a time. Now
Now there are bots and dashboards and predictive analytics.
And kids like Diaz with their spreadsheets and platform theses. He's got vision. I'll give him that.
And capital and a plan. And he's not wrong. Margin compression's real. Competition's changing.
But what happens if I let go and he strips it all down? What if MSP becomes just another tech experiment with a legacy name?
He doesn't want to gut it, Art. He wants to modernize it. If we stay the course, we may survive. But we won't lead. This is a bet, but it's also a bridge.
You know what struck me, Sarah? For all his talk, Diaz reminds me a little of me. Hungry, relentless, willing to take a swing. I just hope he's swinging for the right fences.
Then maybe it's time to pass the bat.